Let's talk about the different ways that you can invest money, okay? Now, the first one is buy and hold, the correct way. I'm not a huge fan of this, of buying and holding, but if you're going to do it, there is a correct way to do it. We'll talk about that and I'll show you how that works. The second is capital preservation and reward. Now, when I talk about 401k investing, and we're going to really focus a lot on this, when I talk about 401k investing, that's going to be really the preferred method to use when you're looking at managing your 401k plan. And the third is what I call opportunity investing, and that's something that you have someone manage the money for you. It's professional money management, and we'll talk about that too. So let's start with the buy and hold the correct way. What you're wanting to look at is what I call extreme diversification. Okay? And this is why this doesn't work very well in 401k plans, because as we talked about, you can't have extreme diversification. You don't have much. I was talking to somebody during the break, and she was telling me that in the government retirement plan, they have like 4 funds. I've seen these. It makes my head hurt. I mean, 4 funds. What are you going to do with 4 funds? It's really tough to manage, but there are ways that you can do that. But you got to have extreme diversification. Think about why. Because if you're just going to buy and hold, you got to have that risk really, really spread out over a lot of different types of investments. You have to really spread the risk if you're just going to buy and hold. The other thing that you have to do is annual rebalancing. Okay, let me tell you what I mean by rebalancing. If you started off, and this is a real simple model, but if you started out in January 2007 and you had 50% in stocks and you had 50% in bonds, and then at the end of the year, let's say you had 52% in stocks and 48% in bonds, it's just because stocks had happened to do well that year. When you start the new year, you want to bring it back into balance. Okay, think of it from the concept, you're in balance, you're out of balance, you want to get back into balance. I've done a lot of research and study on this from a buy and hold standpoint, and the best period of time to rebalance is 12 months. Okay? If you've got a portfolio and you want to rebalance it, you don't want to rebalance it a lot. Just every 12 months works really well. Now, buy and hold the wrong way. I had someone come into my office one time and they had a 401k with them. And he looked at me and said, I'm very well diversified in my 401k. So let me look at it. And so I look at it, and he had 10 investments. His money spread out over 10 investments. But I looked at his investments, and it was a stock fund, stock fund, stock fund, stock fund, stock fund. They're all stock funds. Is that diversification? And you see, that's the thing. That's the key for you to get right now. I can't tell you how many people that ask me questions about this, and they tell me what they have in their portfolio, and there's zero diversification. Because here is what you're not told about diversification. The industry will lead you to believe that you can spread your money over all these stock funds and you're diversified. But guess what? When stocks go down, they all go down together. Right? Now, are there a few exceptions to that? Absolutely. But we're trying to keep this simple. Okay? Stocks as a group, more than likely, are all going to go down at the same time. So you have to think about that from the standpoint, are you getting this real diversification? You know, back in the 90s, when everything was crazy and everybody, if you weren't getting an 18% return, that was the whole idea of diversification in the 90s, because stocks were the place to be. And different types of stocks perform differently. But that's not the case today. And we're just in a particular environment that's not. The other thing is no consistent rebalancing. That's the wrong way to do it. Having a lot of different investments isn't diversification, and no consistent rebalancing. The third is no monitoring. Just forget about it. You've heard of the whole concept of the couch potato portfolio. I mean, it's really advocated. Just forget about it. I think that's really dangerous advice. Just to forget about your investments and not monitor them.